Today, we're diving into a crucial topic for new investors: how to pick your first 10 stocks when starting to invest in the stock market. Whether you're looking to build wealth or just diversify your savings, choosing the right stocks is key. Let's get started. This is Wealth Velocity. Here you create, protect, and grow your wealth fast. Before we start, please be aware that nothing in this video is individual financial advice, and past results are no guarantee for future developments. First things first, you need to understand your investment goals. Are you looking for long-term growth, steady income, or a mix of both? Your goals will determine the type of stocks you should consider. For example, if you're focused on long-term growth, you might lean towards tech companies with high growth potential. If you want steady income, dividend-paying stocks from established companies might be your go-to. Once you know your goals, it's time to start researching companies and analyzing stocks. This is one of the most critical steps in making informed investment decisions. First, let's talk about where to find information. Websites like Yahoo Finance, Google Finance, and the investor relations pages of company websites are excellent starting points. You can access financial statements, news, and analysis reports. Here are some key metrics to focus on when researching a company. 1. Revenue growth. Look at the company's revenue over the past few years. Consistent revenue growth is a good indicator of a company's ability to expand its market share and generate sales. 2. Profit margins. Check both the gross and net profit margins. Higher margins can indicate a company is managing its costs effectively. 3. Earnings per share, EPS. EPS shows how much profit a company is making per share of stock. Look for a company with a growing EPS. 4. Price to earnings, PE ratio. This ratio compares the company's current share price to its per share earnings. A lower PE might indicate that the stock is undervalued. 5. Debt to equity ratio. This ratio measures a company's financial leverage. A lower ratio generally indicates a more financially stable company. 6. Return on equity, ROE. ROE measures a company's profitability by revealing how much profit a company generates with the money shareholders have invested. Now let's dive into qualitative research. This involves understanding the company's business model, competitive advantage, and industry position. Ask yourself, 1. Business model. How does the company make money? Is it a simple and understandable business? 2. Competitive advantage. Does the company have a moat, something that sets it apart from competitors and protects it from being easily replicated? 3. Industry trends. Is the industry growing? Are there any upcoming trends that could benefit or harm the company? Another important aspect is the management team. Research the company's executives and board members. A strong, experienced leadership team can drive a company's success. Look at their track record and how they've handled past challenges. Finally, consider external factors such as regulatory changes, economic conditions, and technological advancements that might impact the company. Diversification is key to reducing risk. Don't put all your eggs in one basket. Spread your investments across different sectors and industries to protect your portfolio from market volatility. Consider picking stocks from various industries like technology, healthcare, finance, consumer goods, and energy. This way, if one sector underperforms, your entire portfolio isn't negatively impacted. Consider to start with blue-chip stocks. These are shares in large, well-established, and financially sound companies that have operated for many years. They are considered to be safer investments with a history of reliable performance. Companies like Apple, Microsoft, and Coca-Cola are examples of blue-chip stocks. They might not have explosive growth, but they offer stability and steady returns. Dividend stocks can provide a steady income stream. These are shares of companies that pay regular dividends to their shareholders, which can be a great way to generate passive income. Look for companies with a strong history of paying dividends and a sustainable payout ratio. Dividend aristocrats, companies that have increased their dividends for 25 consecutive years, are a good place to start. Growth stocks are shares in companies expected to grow at an above-average rate compared to other companies. These stocks typically reinvest their earnings into the business, aiming for capital appreciation rather than paying dividends. Tech companies like Amazon and Tesla started as growth stocks. While they can be riskier, they offer higher potential returns. Make sure to assess their growth potential and market position. Value stocks are shares of companies that appear to trade for less than their intrinsic or book value. These stocks are often found in industries that are temporarily out of favor with the market. Look for strong fundamentals like low price to earnings, PE ratios, and solid financials. Warren Buffett is famous for his value investing approach, looking for great companies at reasonable prices. Another effective strategy is to invest in companies whose products you use and like. If you believe in a company's products and services, there's a good chance others do too, which can translate into strong business performance and stock growth. Think about the brands you interact with daily. Do you use an Apple iPhone, drink Starbucks coffee, or shop on Amazon? These companies are often good candidates for investment because you understand their business from a consumer perspective. When you invest in companies you personally use and believe in, you're more likely to stay informed about their performance and any news that could affect their stock price. Your personal experience can provide valuable insights that might not be immediately obvious from financial statements alone. Now, let's discuss why you should stay away from penny stocks and meme stocks, especially as a beginner investor. Penny stocks are typically low-price stocks of small companies with market capitalizations under $300 million. They might seem attractive due to their low cost, but they come with high risks. These stocks are often highly volatile, have low liquidity, and lack transparency. Many penny stocks are also prone to price manipulation and scams. Meme stocks, on the other hand, are stocks that gain popularity through social media platforms and online forums. While they can experience rapid price increases due to viral trends, they are highly speculative and unpredictable. Investing in meme stocks is more akin to gambling than investing, as their prices can plummet just as quickly as they rise. As a new investor, it's crucial to build a stable foundation with reliable and well-researched investments. Penny stocks and meme stocks can be incredibly risky and may lead to significant losses. Stick to established companies with solid financials and proven track records. Always review the financial health and earnings reports of the companies you're interested in. Quarterly and annual reports provide insights into a company's performance and future outlook. Pay attention to revenue, net income, earnings per share, and forward guidance. These metrics help you understand how well a company is managing its finances and what you can expect in the future. Strong leadership can make a significant difference in a company's success. Research the management team and their track record. A capable and experienced leadership team can navigate challenges and drive growth. Look at the company's leadership history, their past achievements, and how they've handled past crises. A visionary leader can be a strong indicator of a company's potential. Stay informed about market trends and economic indicators. These can impact the performance of your stocks and the overall market. Keep an eye on interest rates, inflation, and employment data. Understanding these factors can help you make better investment decisions and anticipate market movements. Every investment carries risk, and stocks are no exception. Be prepared for market volatility and understand the risks involved with each stock you choose. Diversification, thorough research, and a long-term perspective can help mitigate these risks. Remember, investing in stocks is a marathon, not a sprint. Investing in the stock market requires patience and a long-term perspective. Don't be swayed by short-term market fluctuations. Focus on the fundamentals and the long-term growth potential of your investments. Historically, the stock market has delivered strong returns over the long term. Stay focused, stay informed, and let your investments grow. Stock screeners are powerful tools that help you filter stocks based on specific criteria such as market cap, PE ratio, dividend yield, and more. Websites like FinViz and Morningstar offer comprehensive screening tools to help you find stocks that match your investment criteria. Use these tools to streamline your research process. Finally, investing is a continuous learning process. Stay curious, keep learning, and adapt your strategies as you gain more experience. Join investment communities, read books, and follow market experts to enhance your knowledge. The more you learn, the better equipped you'll be to make informed investment decisions. In conclusion, picking your first 10 stocks requires thorough research, diversification, and a long-term perspective. By following these steps and leveraging AI tools, you can build a strong foundation for your investment journey. Thanks for watching. If you found this video helpful, Please like, comment, and subscribe for more investment tips and strategies. We see you next time with more money in your pocket.